Hello guys, welcome to Wisdom City. This video is going to be in English. If you prefer Hindi, then please do comment in the comment section. I'll come with it. In this lesson, we are going to talk about CRR and SLR or cash reserve ratio and statutory liquidity ratio. These are the two important monetary measures of RBI. Using these tools, RBI controls the cash flow and maintains financial stability. Before we discuss CRR and SLR, we should know about NDTL, that is net demand and time liabilities. Liability is that which is giving you money or profit now, but in recent future you have to pay for that with some interest. If we break its terms, then we'll get demand liabilities, which is payable on demand, that includes your current account deposits, saving account deposits. Then time liabilities, which is payable after a preconditioned time, that is like your fixed deposits, and other demand and time liabilities, which includes interests on the deposits, unpaid dividends, and so forth. After considering all these things, we can calculate the demand and time liabilities of a bank. But to count the net demand and time liabilities, we have to subtract the deposits of that particular bank in other banks. So that you can see the formula of NDTL here. Now you are aware of NDTL. So let's move to CRR. It is the percentage of total bank deposits which a bank needs to keep with RBI as reserves. Why this so? To make a bank self-sufficient to meet its needs at the time of loose action. What does it mean by loose actions? At the time of bad loans or high NPAs. When the CRR is high, liquidity in the market will be low. This control the high inflation. Like this, when the CRR is low, liquidity in the market will be high. This results in high growth and inflation. In India, according to Section 42 of RBI Act 1934, CRR is produced as a liquidity check tool. With the exception of RRBs, all scheduled banks are required to maintain CRR with RBI. Now these days, financial market is slowed down because of the global pandemic coronavirus. To increase liquidity and financial sufficient, RBI has reduced CRR by 1%. Now it became 3% of total NDTL of banks. A bank has to maintain CRR according to its last fortnight's NDTL. If it fails to maintain at least 95% of the cash reserve which is allotted by RBI, then a penalty of 3% plus bank rate is due for 1 day of shortfall. If the shortfall continues, then the penalty will be 5% plus bank rate for the subsequent days. If you want to read the full details of this video, then the link is given below. Now let's move to SLR. It is also the percentage of total bank deposits which a bank must maintain in the form of liquid assets like cash or gold with itself, not with RBI. Using this tool, RBI can control the bank's credit expansion. SLR can neither be lower than 18% nor higher than 40% of NDTL. But with this reserve amount, a bank can earn interest after investing on government securities. But in case of CRR, RBI does not give any interest on the bank reserves. Bank has to maintain 100% of SLR or more than it, as there is no relaxation given by RBI. If it defaults, as of now the penalty of 3% plus bank rate will be levied by RBI. If the shortfall continues, then the penalty becomes 5% plus bank rate for the subsequent days, as like CRR. If I try to elaborate this picture, then let's say 100 is the NDTL of a bank. Then it will give 3 as a CRR in RBI and 18 as SLR with itself. Then the bank only left with 79, which it can provide its customers as loans, DDs, and other credit facilities. If later the CRR and SLR increases, then the bank will left with only less amount, which can be given to its customers as loans, DDs, and other credit facilities. So the liquidity in the market will be low. In this way, RBI can control the cash flow in the economy. Now in this figure, you can easily understand the whole monetary control process. Let's take the case 1. When inflation is high, RBI increases the CRR and SLR so that banks have less money for liquidity. Then to make an average profit, banks increase their interest rates so people don't prefer to take loans with this high interest. Money in the market becomes low. With this less money, people try not to demand. In this way, prices falls and inflation depreciates. In the second case, it is the reverse of the first one. When inflation is low, RBI decreases CRR and SLR. So banks have more money for liquidity. People take loans and the demand increases. So growth initiates and inflation occurs. In this way, RBI controls the cash flow and inflation by its two major tools. Many other tools are also there. We will discuss all of them one by one in our next videos. To get latest videos notifications, subscribe this channel. That's all for today's session. Thank you for watching.